All right, let's dig into a new analyst report that's making a pretty bold claim that one of the biggest tech companies in Latin America, MercadoLibre, might be seriously undervalued by the market. So, what's going on here? Let's find out.
So where are we getting this from? Well, this all comes from a brand new report by Morningstar analyst Michael Miller. He's taken a completely fresh look at this e-commerce and fintech giant, and what he found is, well, it's definitely got people talking.
So after sifting through all the financials, all the data, what's the big headline? What's the one thing you really need to know?
Simple as that. The report's bottom line is that the market is just plain getting it wrong on this one. The shares are trading for way less than what the analyst believes they are actually worth. And that gap, well, that spells opportunity.
Okay, so let's get into the weeds. We're going to start by looking at the actual numbers behind this pretty bold call.
And this slide just lays it all out there, doesn't it? On the left, you've got the market price, what folks were paying for the stock. And on the right, you have what Morningstar thinks the company is truly worth, $2,100 a share. We're talking about a pretty huge difference there, and that gap is really the core of this whole analysis.
But to really get how they landed on that number, you first have to understand what MercadoLibre actually is. Because believe me, it is so much more than just a website.
You know, the best way to think about it is like two powerhouse companies got fused together. You've got the e-commerce side, which is basically the Amazon of Latin America. But then you have this booming fintech platform for payments and loans. And this whole machine is running across 18 countries, with the real engines being Brazil, Argentina, and Mexico.
And check this out. This table really shows you they're playing in the big leagues. When you put them side by side with global names like Amazon and PayPal, you see they're a serious contender. And look at that economic moat rating from Morningstar. Wide. That puts them in some very elite company.
So that brings us to the next big question. What makes this company so tough to beat? Well, it all comes down to something called an economic moat.
What's the secret sauce here? What is it that protects them from all the other companies trying to get a piece of their pie?
Okay, so an economic moat. Think of it just like a real moat around a castle. It's that protective barrier that keeps invaders, or in this case, competitors, out. And Morningstar does not just hand out their top rating wide to everyone. That tells you they think MercadoLibre's defenses are seriously strong and built to last. The report says this moat is built on three key pillars. First, you've got this incredible network effect. The more people that shop on the site, the more sellers want to be there, which, of course, brings in even more shoppers. It's like a snowball rolling downhill. Second, it's just a real pain for sellers to leave. With shipping, ads, and loans all baked into one platform, switching to a competitor is a huge headache. And third, data. Oh man, the data. All that information on what people buy and sell gives them a massive advantage, especially when it comes to making smart loans.
Okay, but it's not all sunshine and rainbows, right? No company is a sure thing. The report is super clear about the two sides to this story, so let's look at the bulls versus the bears.
So on one hand, the bulls, the optimists, are looking at this huge, untapped market. 85% of retail in Latin America is still happening offline. That's a massive runway for growth, not to mention their whole fintech and credit business. But on the other side, the bears, the skeptics, are saying, hold on a second. What happens if a global competitor gets serious? What about new startups? And you can never ignore the risk of a regional economic slowdown. These are all very real concerns.
So you've got the huge potential. You've got this serious risks. How does the analyst balance all of this out to actually come up with a final number?
It all comes down to the forecast. So let's look at the actual numbers, the key projections that are propping up that big $2,100 valuation. First up is something called GMV, or Gross Merchandise Volume. Basically, that's the total price tag of everything sold on their site. It's a measure of pure scale, and it's expected to grow by almost 13% a year, every year, for the next 10 years. For a company this big, that is just incredible growth.
But here's where it gets even better. The actual money they make from all those sales, their revenue, is projected to grow even faster at over 17% per year. What that tells us is that they're getting smarter and smarter about making money from ads, shipping, and all the other services they offer.
And this is the kicker: profitability. As they get bigger, they're expected to get way more efficient. Their operating margin is forecast to jump from about 11% to over 18%. That means for every dollar that comes in, more and more of it will drop to the bottom line as pure profit. That's a beautiful thing to see.
And this quote from the analyst really just nails the whole philosophy here. He's saying, look, they're spending a lot of money right now, and that's okay. They're not focused on making a quick buck. They're investing heavily to capture this massive opportunity for the long haul, and he thinks that is absolutely the right move.
So what's the big takeaway here? You've got this incredibly dominant company with a huge path for growth ahead of it. But, and this is a big but, the report also gives it a high uncertainty rating. The risks are real. So the ultimate question this analysis leaves us with is, will that wide, powerful economic moat be strong enough to fight off the risks and turn all of that potential into profit? Well, only time will tell.